And welcome to this episode of the Capitalized Life and Retirement Show. I'm your host, Matthew Johnson, president and owner of Johnson Wealth and Income Management, a retirement income source located in Clear Lake and Humboldt, Iowa, serving clients in northern Iowa and southern Minnesota. Well, I hope you're doing well today. Thank you for stopping by. Thank you for taking some time to watch today's video. Today, I want to actually do something that's very out of the ordinary. Today, I want to have a discussion with you personally to maybe take and I want to challenge a narrative that we have been told over and over and over again. I've been in the business as an advisor for 27 years now. And the reality is that I don't remember a year ever, and there probably even in past history has been never a time in which the financial services industry has looked at you as the American, the up-and-coming retiree, and said, you've done everything necessary. You've got the gold star. You've saved enough. In fact, it's the absolute opposite. What we are being told as Americans is that you're not going to have enough. You haven't saved enough. You haven't worked hard enough. You got to work longer and harder and save more. Okay. And, in some respects, that's probably true. There are many that they were late bloomers getting to the retirement savings part of their life. And so they are behind, or they're focusing so heavily on what they have to pay off that they can't afford to save a lot. There's probably 1,000 different dynamics and 1,000 different scenarios out there that are preventing a person from saving what they probably should. But the reality that I want you to be able to see is that we are in a position right now where, quite honestly, I wonder if it is all your fault. Now, if it's all your fault in the respect that you're not doing enough, you're not saving percentage-wise enough. Here's what I mean by that. When we think about being aggressive, when we think about risking money, being aggressive and risking money doesn't sound really all that great, especially to a lot of people, especially if you're maybe more so in the conservative Midwestern mindset. However, if you're in the accumulation stage of your life, you're 20, you're 30, you're 40, you're 50, you still have 10, 15 years before you get to retirement, okay? I want to ask you a very serious question. Are you playing it too small? Are you not being aggressive enough? Because the reality is that we need to be utilizing the stage of life that we are currently in and investing properly for that stage. I don't say this to be derogatory, but you know what? I've got a lot of people that are younger, that they're acting and investing like they are 60 and 70 years of age. And that is something that needs to be broken. That is something that needs to be challenged. That is something that needs to be overcome. I'll give you an example. Many of my clients who are, say, 60 and above, they are so passionate about what I've taught them and they are so juiced up over it that they say, I want you to talk to my kids. I want you to talk to my grandkids. And I love that. I think it's the highest honor. It's the greatest compliment that a financial advisor, a business owner in general could receive, a referral. I know that they're doing it to their kids. When their kids come to me, they're like, oh, mom and dad just rave about you. And I don't say that to be cocky or arrogant. It's just what I hear. But the thing is that oftentimes parents can be very, very detrimental in their children's lives by trying to telegraph upon the child their stage of life investments. So even though the parent is older, they're closer to retirement, maybe in retirement, they've got to be more conservative. They've got to be more focused on principal preservation and less on risk. And they're thrilled with what we do in reducing risk and exponentially increasing the output of income. They're taking their excitement and they're putting that onto their child. And the reality is that if you're in 20, 30, 40, 50 years of age, you ought not to be doing that. You ought not to be doing that. You should be focusing on growth. You should be focusing on appreciation, the value of owning assets that are going to appreciate over the course of time and continue to grow and compound and become more valuable. So I want you to just think about this. For instance, if you look at the national statistic, right now, individuals 65 to 74, the average person has about $600,000 saved for retirement. 401ks, 403bs, IRAs, Roths, you name it, collectively together about $600,000. However, the median, the middle of that statistic only has $200,000 saved. And this is the part that gets me. I just cannot help but wonder, is it possible that you have been saving percentage-wise enough? I often find that people that come in to have a second opinion, even though they're not really retirement age yet, when I look at how much they're contributing to their 401k, they're just pouring the coals to that thing. They're putting 10 and 12 and 15 and 18% or the most that they can possibly put into that 401k. Now, you may not be doing that, and maybe you should be doing that. But it's not the percentage that I see that's the problem. The problem is that they're not being smart and aggressive at the same time. And you see, the reality is that if you are behind in retirement savings, I wonder if why you're behind, why you're here instead of here, is because you have allowed the personal sense of conservation, personal responsibility. Well, I'm not a giant risk taker. I've listened to my parents all of my life. I wonder if that hasn't done you a disservice. I think another thing that we have to be absolutely clear about is we are living in a world that's right now kind of in a constant state of flux. We have inflation that is going to be the child of these tariffs. We know that it's going to happen. It already is to some extent. Now, I'm not saying that the tariffs are bad. I think that oftentimes tariffs are a wonderful thing. And I think we have been, in many respects, historically and factually taken advantage of by other countries. Of course, why wouldn't they do that? If we're not going to say no, if we're going to roll over and play dead and play possum, why wouldn't you take advantage of another country if you could? Okay? But that's not the point. The point is inflation is going to be one of the byproducts of tariffs. We know this. It's not a mystery in any way, shape, or form. And so the thing I want to ask you is, if today an item that costs $100, 10 years from now, when it costs $127, are you doing enough today with your money? Are you being aggressive enough with your money today if you've got more than 10 years to retirement to grow the money properly through appreciation, through exponential growth, so that you're taking into account for what the cost of living may be in 10 years, in 15 years, how many ever years before you get to retirement. Now, here's another thing that I want to maybe just ask you to think about, and that's the opportunity cost. You know, stocks are probably never going to cost in the future what stocks cost today. They're probably going to cost more. And if you are a student of history, if you've looked at the stock market over the course of time, and again, I'm as a financial advisor and a fiduciary, I want you to maintain, if you're within 5 years of retirement or you're in retirement, I want you to focus on principal preservation, exponential income growth as a byproduct from how you're investing. But if you're on the accumulation stage of your life, I want you to think about the opportunity cost that you are currently paying by playing too small. I'll give you a for instance. I had a client, or have a client, who's a relatively new client. And this relatively new client had really always been extremely conservative. Very, very conservative. This is the way that the client was raised by their parent. And so as a business owner and needing some guidance, not really understanding how to use retirement savings accounts as a tax advantage and to help save for retirement. So when they sell the business down the road, they're able to now have a bucket of money to live off from and have income. This younger investor decided that they needed to hire me as their advisor. And so we started out with a pretty good chunk of money. They were good savers, all in the bank, of course, because they were very conservative. And it was interesting to me because this person has deposited the money. We have agreed as to how we're going to allocate the money. And certainly I was warming them up to being aggressive with their money, basically taking a 50-50 approach where half of the money was allocated contractually towards fixed income things that were going to be producing 4 and 5 and 6% or better in interest and dividends. And the other 50% of the money was going to be more owning stocks, and some of those stocks owning stocks that paid dividends. A month has gone by and I get a panicked phone call that their account has dropped by approximately $500. Now we're talking 6 digits, six numerical digits, and they're concerned about $500, which turned out to be, shall we say, in the hundredths of a percent. Now this person, at this stage of their life, should have been super aggressive. They obviously did not have a tremendous handle on investing for growth. They had never done it. And so to see their account go up a little and to see their account retrace even less, it bothered them. So you see, knowing yourself is a very important component. And in the same way that I reminded my client, I want to remind you that sometimes your emotions can get in your own way. Sometimes you're in a position where your own mind, your own heart, your own gut, your own emotions will prevent you from doing something that is actually in your best interest. And this is the opportunity cost. Stocks are one of those things that has been proven time and time again to be one of the best and most material things that we can own to appreciate and grow our money between now and the time that we retire. And yet we may be staying away from them. You may be staying away from them because you don't understand them. They might scare you. You don't have an advisor. You may be trying to do this yourself. You may not really know how or what to do. And so that sense of that sense of lack of understanding stymies you. You're now in analysis paralysis. You do absolutely nothing. Years and years ago, I heard a famous horse trainer by the name of goodness. Now I forgot his name. Anyway, it's irrelevant. But he made the comment, he said, frustration begins where knowledge ends. And I think that that's a perfect quote. I think that that's an absolute necessary thing for us to understand about ourselves. And this is the reason why I reminded my client that she needs me. This is the reason why I remind you that you need an advisor. You need a fiduciary, someone who is completely and totally emotionally unattached to your money, to be able to make the right decisions, sometimes tough, sometimes scary, sometimes in the midst of chaos and uncertainty. But someone who you know you can trust to make that decision because you're not capable or you don't simply want to make that decision for yourself. Now, sit tight. We're going to come back. This is our first break. Sit tight. We will be right back where we're going to talk about, okay, how can you start to begin to fix this for yourself without going absolutely crazy. Sit tight. We'll be right back. And welcome back to the second half of the Capitalized Life and Retirement Show. I'm your host, Matthew Johnson, president and owner of Johnson Wealth and Income Management, a retirement income source located in Clear Lake and Humboldt, Iowa, serving clients in northern Iowa and southern Minnesota. Well, how are you today? If you're just joining us, welcome to the program. Welcome to this little video podcast that we're doing. If you're brand new to this radio show, I just want to say a special welcome. If you've been looking for a place to be able to just learn some really down-to-earth, practical knowledge and wisdom about saving for retirement, being able to be successful in retirement, making that transition from the accumulation stage to the distribution stage without going broke, taking that money and making that money that you've worked so hard to save safe, and then making that money work for you to produce income that you can't ever outlive. Well, if that sounds attractive to you, you have certainly found the right place. Now, today we've been discussing this narrative that we've been told for decades that Americans aren't saving enough, that we just simply haven't been working hard enough. We haven't been saving enough of our paycheck. And, maybe that is true. Maybe part of that is indeed true, that you haven't been saving enough. But I find oftentimes when I'm reviewing with individuals that they are. The issue, I wonder, is whether or not they've been aggressive enough. So in the first half of the program, if you haven't caught it, I encourage you to watch it. We spent a good deal of time just trying to really encourage you to understand how important capital appreciation is. Being able to not only save enough is important, but how you invested, what you invested in. Keeping in mind that you've got years before you get to retirement. If you're 20, 30, 40, 50, okay? Now, if you're 70 and you're watching this, I'm not encouraging you to take a bunch of risks with your principal. But we're talking about the individuals that are very much in the accumulation stage of their life. You're here to grow and to get as much growth on that money as is possible. So capital appreciation matters. When we're living longer than ever before, you need to make certain you've got a bigger bucket of money than most other generations. And that means that you've got to be able to identify the stage of life that you're in and the type of tools that's going to give you maximum growth, maximum appreciation. Now, here's the thing. We don't have to be reckless about this. I've taught all of you, if you've been a routine listener, that there's two ways to grow our money. We can grow our money through appreciation, but we can also grow our money through interest and dividends. And so if you happen to be like that one younger client where she's never known anything other than just a bank CD, and so this whole idea of investing in stocks is new, it's kind of scary. It's something that they're not really used to. It's something where we're not used to the ebb and the flow. We're used to a straight line. Okay? Well, I want to encourage you that you don't have to go completely bonkers. You don't have to take and put 100% of your money into the stock market. In fact, I'm not encouraging you to do that. But I do want to encourage you to understand that there's really kind of three buckets of equities that I would ask you to consider. So the first is this. Let's talk about just pure growth plays, okay? These are going to be companies that are going to pay little to no dividend. And these are companies that really don't want to pay you a dividend because they need as much of their working capital as possible. They want to continue to reinvest it, just like the business owner, back into the business and continue to innovate and continue to grow and have research and development resources and money. And they want to be able to bring shareholder value. They want to be able to grow their bottom line. Okay. I want you to think of a company like Apple when you think of this. Okay. And owning growth stock is going to be very imperative if you're going to grow. Now, I said it a little earlier, I'm not a major fan of mutual funds. And the reason I'm not is primarily the expenses. So if you feel uncomfortable picking stocks, that's okay. If you have an advisor, it's the advisor's job to do that. But if you want to use a diversification of tools, you can look at things like index funds. Okay. If you own the S&P 500 index fund, you will never do worse than the S&P 500. If you own the NASDAQ index fund, you will never do worse than the NASDAQ index. If you want to focus on growth companies, there are plenty of growth index funds. There are things called ETFs, exchange traded funds. Those things are typically low cost. They have more of a mutual fund feel, but they're going to be lower cost. And they're going to provide you with that opportunity of you being able to select the types of companies that are inside that you want to invest in. So we got growth companies, very little, if any, dividend because it's all about appreciation at the end of the day. Now let's swing the pendulum the other direction. The other direction is going to be things like blue chips. Okay. Dividend aristocrats, blue chips, companies that have been around for 100 years, companies that have always paid their shareholders dividends, companies that have always increased the dividend to their shareholder, which is the reward to you for taking on that stock and owning it, taking on the risk of that company. And these are companies that are probably not going to give you double-digit rates of return, but these are companies that are going to pay you consistently month after month, year after year, dividends. Now, why is the dividend important? Well, the dividend is if the market just happens to be not doing so well, maybe it's going down, you're still going to get paid something. That's kind of nice. But the most important reason for dividends is because think about it. If you're getting dividends, you have something to reinvest. So chances are you're saving, you're contributing to your own retirement. But if you've got dividends and you know how to get them and you know the companies that are going to pay you those dividends, those rich, big, fat dividend checks, those are those dollars that you get to reinvest and reinvest and reinvest and reinvest. And see, there's only one thing better than you investing for your own retirement. That's you investing for your own retirement plus dividends helping you to have even more money to invest. So you've got the growth companies. Now you've got the dividend paying blue chips as well. Now, what's the third category? The third category I want to challenge you to be thinking about. And this is something that I think is often overlooked. And it's unfortunate because it's so important, I think, in the realm of investing. And that is blue chips. So not blue chips, value stocks, excuse me. So value stocks, what is a value stock? A value stock is the stock of a company that's essentially fallen out of favor with Wall Street. This is a company that, I'm not going to say they're circling the drain, but this is a company that has just simply fallen out of favor. Maybe they've had some bad management. Maybe they've had some regulation that came against them. Maybe things just didn't go that well. Okay. And we have to be smart about this. We have to do our research. We have to be thinking about the companies that we're investing and we need to research them. Okay. Or the advisor or his team needs to be researching these. But a value stock, if the idea of paying less and getting more, if the idea of paying less and getting a bigger, fatter dividend sounds attractive to you, and let me tell you, value stocks can be a very attractive option because these are companies that for one reason or another, they're down. They're down. And I don't know about you, but when I buy things, I like to buy them on sale. And so if you think about this, this makes a powerful a powerful group of investments. You've got the companies that are over here that are growth, pure appreciation, very little dividend. You got the blue chips over here that are paying you 4.5%, 5% dividends. And then you got the value stocks, the companies that are down on their luck, companies that may be really well managed. And guess what? They're going to pay you a good 3.5% dividend, but they may end up not only growing, but outperforming the blue chip and holding their own with the growth stock. And you see, if you're investing properly between those three categories, those three areas, now you have a real shot of being able to do what needs to be done and not playing small, not being too conservative, but investing properly for the stage of life that you find yourself in. When you're within 5 years of retirement, then you can back off the pedal. When you're within 5 years of retirement, then you can really start to focus on principal preservation, and you can focus on interest and dividend production with the vast majority of your money. But if you're sitting in a position where you got 10 or more years to retirement, I beg you, I implore you, do what is right. Not only do everything you can to be investing the largest percentage of your paycheck into saving for retirement. You will never regret that. But also be prudent as to how you're investing those dollars. And I know not every 401k is perfect. But here's the thing. You don't have to simply use the 401k. If you're in a position where you got a 401k and you're like, that's great, but I'm on my own on the 401k. And Matthew, I need someone like you to help me. Well, guess what? There's absolutely nothing that prevents you from opening up a Roth IRA, a traditional IRA, an individual or a joint post-tax brokerage account, so that not only can you continue to funnel money towards that 401k, just like you've been doing out of your paycheck, but now you can begin to bring diversification to what you're investing in that 401k by investing privately, personally, on your own, outside of that 401k. This is what real investors do to help diversify. If you put all of your focus on one employer retirement program, that can lead to detrimental results because you're in the goldfish bowl, their goldfish bowl. You're paying what they tell you to pay. You're focusing on the funds that they have and the funds that they have only. That's it. And you may be very well acquainted with being claustrophobic within that 401k. I ask you, think about breaking free of that and focusing and doing things individually on the side, personally, where you have the entire universe of options at your disposal. I'm Matthew Johnson. Thank you so much for listening and watching. If you're interested in more resources, I encourage you to go out and get a copy of my book, The Capitalized Retirement. It's available at all major book resellers. I encourage you to go to my website, johnsonwim.com. I also encourage you, go to that website and look up the Capitalized Retirement videos, just like this on YouTube. You can go back and listen to previous radio shows. You can even read the educational white papers that we have on the website, all committed to your education and your edification so that you can have the retirement of your dreams, a retirement in which you have more income than what you need. I'm Matthew Johnson. Thank you so much for watching and listening. And remember, it's up to you to make today a great day.